Welcome to Front Range Facts. This is Anthony Meisner.
And this is Jim Arian.
Came to bring you your national update today, so let's dive right into it.
Yeah, we got three different topics we want to cover today. The bottom two are going to be a mystery until we get to them. But our first one is going to be a deep dive just into looking at the national inventory trends. And so here in the first one, if Anthony dropped down for 1 second and do the limo, this is the same week in 2023. And, so clearly when you're seeing these news about inventories rising through the country, 36% increase, it's comparing against last year, but last year was hugely artificially depressed, wasn't it?
Yeah, absolutely. So with it being so depressed, this puts it up against 2019. You can see where we were then, and we are in a very much still a tight inventory situation nationwide.
Very much, yeah. 2019 inventory levels were pretty good, healthy kind of years. You can see from this 2017, 18, 19, and Anthony and I are kind of blocking those numbers, but that's, what we're looking at for active listings. So ever since, COVID basically popped the bubble on some of that inventory levels, and we've got now this massively depressed, inventory levels, which again are going to continue because people are sitting on the golden handcuffs of low rates. So don't expect it to go back to where it was for a while.
Absolutely. And inventory just is rising overall, and that's fine because you've got a lot of buyers sitting on the sidelines and sellers are very motivated still in some cases. So when they are motivated and you don't have enough buyers is what happens. But Check this out. Nevada actually down in inventory, New York down in inventory, Connecticut, New Jersey. There's a few.
New York did lose a lot of people last year, so it's not a surprise that they really aren't having the same inventory levels they did last year. Nevada is the question mark we talked about in a previous episode. It kind of defies the usual trend with Nevada being the first to be the canary in the coal mine. But Florida, look at that, 64.2% increase.
It's insane, isn't it?
I think those condo laws are coming into effect about all the financial burdens they have.
Yeah, and look at the rest of the South. I mean, you're talking mid 30% range across everywhere from Texas all the way to North Carolina. So definitely some major inventory shifts across the country. I would expect that to continue for a while, right?
Yeah.
What about number two?
Well, a lot of people and a lot of headlines are like, oh, the institutional buyers are, taking all the homes from hardworking Americans and they're jacking up the prices. And, gosh darn those big companies. Certainly in some markets, I'm not going to denigrate the idea. In some markets, especially in the South, and probably around Phoenix, we saw a lion-sized share of some of these institutional buyers buying up a lot of cheap property because the price was good, right? But in the context of everything, let's just look at this. So all this stuff you see on these things are what we call institutional buyers. So people who are buying, companies that are buying between 100 to 999 homes are that gray line. And then that lighter blue is companies that own over 1,000 properties. How much are they buying? And then the iBuyer is that term that we use for those companies that essentially will buy a property and on your behalf, and then, they'll buy it from you, and then they'll put some lipstick on a pig, paint, carpet, and then resell it and try to make a profit, right? And so that business jumped huge during the last few years.
But it's still only 1%. I mean, I think that's the big thing about this is when you look at these institutional investors, they still represent less than
it's 2%. It's about 2% of the market right now. And since this has been happening since about 2012, 2013, I wouldn't be surprised to see a 1% to 2% share of the market going forward nationally. With it once it evens out.
For sure. All right. So what about this one?
Well, this is the other thing too that people don't realize. This is all types of investor buyers. So anybody who owns more than one home.
1 to 9 properties is 18%.
Yeah. So that big, huge light gray thing are all the mom and pops out there that held on to their first home and bought a second home, or they bought a home for little Anthony over here when he went to college as a condo, kitty condo kind of stuff like that. So they're the bulk of the institution, the bulk of the investors out there. And as you can see, even if you add all that together, in a low year it was 12%, right where my fat head is blocking, was about 12% of the market. And now they're, in that, about 25% share total of the market. So it's growing.
They are growing.
We're seeing it, dip down again. But there's a lot of people who have sitting on so much equity, they're refinancing the one they have, pulling cash out, buying a second property. So you're seeing a lot of that in play, just the massive jump in prices.
This puts it into perspective when I looked at it. So a Blackstone, being the number one largest buyer of real estate right now out there, it represents 0.06% of the market. Yeah. So I think it kind of says it all that the normal housing market is still what's the major driving factor between all of this. It really is not these small companies or mom and pops driving up the cost of real estate around the country.
Yeah.
All right. What about number 3? Housing predictions.
Productions and shortfalls. Yeah. So this is the thesis Anthony and I have been talking about for over 5 years now. We haven't built enough homes, right? Ever since the 2008 crash, right?
I mean, it's out of control. Yeah. And this last couple of years has made it so much worse. So it's just not not easy. So look at this. This is a crazy index. Explain the index, because
Yeah.
I was a little
So,
confused. On the index.
this is basically how hard is it to be a home buyer in the country, right? And so when you look at where it was in 2012, 2013, that recovery period, that's about when we started to recover from the 2008 economic crash. We're roughly around 50 on the index. And, things got better as, the interest rates dropped down. So part of, the cost, went down. The supply was going up. So it made being a buyer relatively easier in 2014, 15.
Yep.
In 16, it was good. And then 17, 18, 19 started to go up a little bit above, that kind of threshold. And clearly you can see that once that 2020 dip occurred, then it rocketed right up.
Seriously.
And that's where we've been bouncing around since. So, how long is it going to take for the home buyer scarcity index to go back down to 50? I've seen some people prognosticate about 3.5 years or so, depending upon where interest rates go and where home prices go. Could be a little bit longer than that, but I don't think it'd be any less.
Well, it's good news actually for buyers that in the next few years maybe they'll feel some relief, because that would be helpful.
Yeah, and then this one right here, is how many homes in the market right now are being are new construction versus resale, right? And so the average, if you look from 83 to 2019, 13%. However, we're at 33% today. And
That's
so,
pretty
right. Now, why is that? Well, a lot of people who would be selling that have a resale home are not selling, right? So the share of builders, maybe they haven't changed much with their share, but what they're competing against in this has dropped quite a bit, right? So there's just less resale homes on the market. Thus, it artificially inflates
the percentage number.
Yeah, it looks like they're doing a better job building, but they're not.
But they're not.
But just one other thing, they did all buy a lot of cheap financing, and they're offering that to people so they can come in and undercut a buyer of resale home by 2% off of your mortgage or so.
Yeah, absolutely. This one's interesting because basically leading up to 2008, we had the 4 biggest years of home building ever in the history of the country. Yeah. And then obviously we hit the reset button quite a bit in 2010, 2009. And then we've kind of been building back up. But I mean, what is the metric over here on the side? It says 1,000. That's where we are today.
Mm-hmm.
So what does that mean?
That means we're back at the same building level we were in the 70s, Anthony. I mean, that's really what it comes down to, right? Like when you think about it.
I mean, that's messed up because the population's like, I don't know, 3 times or 2 times what it was.
If we flip to the next slide.
This one?
Do that. Right here.
Oh, here it is.
There it is. So, what we have here is, looking at 1970s. Look at the bottom of the screen where our heads are, right? 1970s through 2020s. And that number of homes added per person was 0.76 in 1970s, 0.67 in the 80s. Then in the 90s, it dropped like a freaking rock to 0.4. It started to recover in the 2000s, but again, then you had the crash, right? And so in 2010s, it went down to a level just like the 90s. And then in the 2020s, just as we were starting to get good at building again, now this whole, impact of high interest rates,
for real,
happens again. So now the builders, based upon their public reporting, they all pulled back on projects. They stopped doing investment in building more. So we're probably going to see that number continue to decline since we're only in 2024, right?
Absolutely.
And then just real quick, the last thing we wanted to show you was a little mea culpa from some of the big lending houses here.
Yeah, this one is interesting to see a 0.5 point adjustment from pretty much everybody across the board. But honestly, after looking at what's going on this year and with the Fed not changing a ton of rates and just the way the bond market's reacting, I'm not surprised to see this. And I also still think that Fannie Mae and NAR are optimistic in these predictions. I really do think that at best we will see this. We probably will see these numbers this year. I just don't think that's going to be like, I guess if it was the 31st of December and that was the number, then they win, right? But in all reality, it will probably bounce around somewhere around there for a while.
We're over 7% today, and here we're about halfway through the year.
We're 7.25.
Yeah. So, I mean, sure, like September is when now the Fed, Vegas money says the Fed is going to lower rates, right? And they're going to lower it like, 0.25%, maybe. That's going to be what they're doing, guys. They're going to do a little baby step into things and stuff. And it's not going to drop the threshold all that
But
much,
if we do see a 0.5 point drop over time or over, a quarter or something like that, that actually will make a big difference. You will see buyers re-enter the marketplace. Yeah. So I do think that everybody still feels like we're all heading in the right direction, which is a really good sign, right? Because then maybe we'll actually get some relief for buyers out there. It just might be a little bit longer than anyone anticipated.
And the gap between treasuries and, mortgages is still over 2%. 1.71 is where it should be. So there clearly is some room for interest rates to go down here. Over the history, we'll see that happen. But yeah, it's we'll be lucky to hit this number at the end of the year.
For sure. All right. Well, thank you for joining us today on our national update. I'm Anthony Meisner with Land Title. You can always reach out to me at 303-968-9868 or ameisner@ltgc.com.
And I'm Jim Marion, realtor here at Coldwell Banker. You can call me at 303-548-0243 or shoot me an email at jim@ourcoloradohomes.com.
Don't forget to tune into our other podcasts. We have a Colorado update and a local update coming out for you soon.
Take care.
Bye.